Back at it with another one. What's up, guys? Here it is, Open Door today. We're taking a look. Big changes in the stock price, big changes in management. Is Open Door still a buy as of today in 2025? I'm sure you've all been seeing the ticker open all over the place, social media, everywhere. Basically, what do? They directly buy homes from sellers. In some scenarios, they'll actually renovate them. Other scenarios, they'll just resell them. They offer some other services like brokerage, title, insurance, escrow, the marketplace to connect buyers and sellers. That's their whole shtick here, very similar to a Zillow, with their buying platform being, of course, different, because they can give, cash offers, they can pair you with someone. It's essentially a marketplace. For what it is worth, I like to hop on Opendoor and do some quick research. I tried to look at selling my house just real quick on Opendoor. Interestingly enough, Opendoor said they wouldn't buy I have a pretty nice house, not to toot my own horn or anything, but they wouldn't buy the house, which was odd. And then they referred me to a Mark Spain real estate. And I also did the same. So maybe I live, too close to the beach. I'm in Florida. Okay, maybe let's just check out Philadelphia. I grew up in Philadelphia. So I look back there and there's no homes for sale in the marketplace. And when I put an offer on the house that I grew up in, again, I'm referred to some third party, not directly Open Door actually purchasing. Just some thoughts I wanted to share as I go through my research on the company. All right, so what's the bull case here for Open Door? Well, the Fed's meeting in September, and most likely the rates are going to get cut 25 basis points, 50 basis points. People are projecting in several cuts throughout, the last half of 2025 and the first half of 2026 into three rate cuts, because the Fed doesn't like to move super fast. With interest rates, potentially declining post 2024 to 2025, home transactions could significantly rebound. Open doors moving away from heavy home buying inventory towards, the agent referrals and the partnerships, which is, I guess, the anecdote that I saw when I went to sell my one of the two homes that I know and have grown up in or live in, and it was referred out to that Mark Spain group. In the best case scenario, Opendoor will essentially become the Amazon of real estate. And that's the bull case thesis that I see here for Opendoor. So then, to play the devil's advocate here, what's the bear case? And I got the cute teddy bear here instead of the tough bull. Um, there's persistent unprofitability at Opendoor. On a free cash flow basis, net income, cash flow from operations have all been persistently unprofitable. Furthermore, they have significant debt load, which you'll see later in the DCF. They also face several challenges from the market, right? There's Zillow, there's Redfin, traditional brokerages, and then you'll see in our market analysis some other companies like a Compass, who have very similar offerings to what Open Door is doing. So here's something interesting. Open Door actually changed their CEOs, and the new CEO, I believe, is the former CEO of Shopify. And pretty impressive compensation package here. I'll highlight. $1 here is his total compensation, but obviously, right there's some incentives here. He's being gifted about $82 million in shares right there, and it's vested over a 5-year period. And without getting into it and too complicated, basically, he has these targets here, $9, $13, $17, 21, 25, 29, 33. If he meets every single target and gets up to that 33, that's a potential max out cap of $2.6 billion in total compensation. And the company's $24 billion in size. So definitely, if he can get this machine going, he definitely has the financial motivation and incentive here to get it going all he can. So just in case you haven't seen, the movement in the stock recently, I just got two clips here, screenshots. One on the left here is Opendoor, their chart ever since IPOing here in 21, 22. And you can see it's down 9% all time. You can look up studies too. Historically, IPOs that have debuted over the last 20 years have had very lackluster returns. Anyway, getting back to the point here, Open Door Technologies over the past year is up 385%. And you can see that big spike there in the end is particularly over the last couple of months. And there was a large spike when the announcement of the new CEO from Shopify came in. So here I just wanted to show the company's most recent guidance going into Q3 here. This was announced in their Q2 earnings. There's been a downward revision to revenue, then EBITDA guidance is still unfortunately negative. So this will flow into the discounted cash flow on the next tab. So you'll see, they're running a profit now, but in 24, but in 25 we'll project that first year downward. Given this guidance, and then hopefully when interest rates, if they go down and get cut by the Fed, that's what we'll assume, they'll see a nice little rebound in revenue here. So here's just a quick summarized DCF, just showing the main inputs here with revenue here, free cash flow, the sum of the free cash flows, how we get to enterprise value, and then our target share price and margin of safety. So just a real quick walkthrough on, how it's assembled. Revenue built, with 2024 numbers. This is in millions, so 5.1 billion. They have negative 12% free cash flow, yielding about negative 618 million in free cash flow. So they're going to have to start pulling on debt here to maintain operations going. But going forward here into revenue, I have it grown at negative 20%, which is the analyst consensus, which if you remember from the slide before is, coming from guidance from Open Door saying, EBITDA, free cash flow, and profit margins will all be descending. But then, as you see, I have it revving back up here to before, even a little more above analyst consensus here to really kind of show the bull case here that with 35% growth, they'll be at 5.5 billion in revenue, which is where ahead of where they were in 2024, and that unfortunately they're still projecting here negative free cash flow, but that's going to be due to some capital expenditure efforts in building out the company and the new CEO. Um, I'm projecting another 30% increase there. I think, there's going to be a series of rate cuts going in 25 bips, 50 bips, 75 bips. Some people are pricing in 50 bips. I think 25 is more likely in September, and I think it's going to, continue downward at 25 bips for a total of 75 bips slide, which in turn, the housing market it has an inverse correlation with interest rates, right? Interest rates go down, housing goes up, and interest rates go up, housing goes down, right there. More expensive interest rate means higher mortgage payments. That's why people aren't buying. Um, Going in, assuming they can gain some more market share, will just stay ultra aggressive here. Bull case. I mean, they have a lot to prove to be able to get from 5 billion to 9 billion here in 4 years. But just to display it to you here, from a financial perspective, that would put them at 9 billion. And then at 15%, the momentum starts to grow, and you know the terminal year is kind of hard, right? This is where the bulk of the value comes from. As you can see, it's 15 billion of the value is coming here before it's discounted. So I mean, after discounting, you can say it's about 8 billion, and all the years before that are hardly any. So I mean, what you really want to focus on, and you hear this all the time from value investors like Warren Buffett or anything. You want to project the terminal, not where it's at. Price to earnings now is useless. EV to EBITDA now is useless. It's what the present value of a company is equal to the present value of its future cash flows. So if you can guess what into perpetuity, how big the company is going to be and how profitable it is, that's what you really price it off of, not the first 1 year, 2 years, the current performance here. Although pricing it in 1 to 2 years would probably be more accurate than the historical. But anyway, So looking at analyst consensus here on the tangible addressable market and how much they can penetrate that market, there seems to be firm analyst consensus here that they can reach 11 billion in size. That would be just a little more than a double, about 220% there from 2024. Um, Looking at that, we slowly start to going back to cash flow. We slowly start to increase their free cash flow from 6.4 minus 4.7, which is from the capex, and then it goes up to 2 when those rate cuts and they start to realize more volume here from the drop in rates. And then we slowly start to ramp them up at 6%. And in the terminal, I have it set to 14.4%, and you'll see here on the next slide in the comparable company analysis I believe that that is the highest free cash flow of the comps assumed. I believe it belongs to Zillow. We can check there on the next slide. But so again, just to show the ultra bull case here of extreme growth here, we're going to assume they start becoming profitable in 2027 and they can reach 14.4%. I mean, this is a lot of assuming, and for this, typically you'll see someone more in the 9 to 10% range, but the 13% range here is more fitting to kind of account for some of the risk you see with some of the more aggressive assumptions we're making. And if you can go to the free cash flow here, the sum of the free cash flows, we get about 9.4 billion. Again, the bulk of that coming from that terminal period here, assuming 11 billion in revenue and an aggressive 14.4% in free cash flow. The time value of money, $15 billion dollars all the way into perpetuity would be worth about $8 billion, dollars, assuming a 13% discount rate in a mid-year convention. Um, so back to it, we're at 9.4 billion here in free cash flow. Then you subtract out cash because again, I've went through this. You can look it up. Enterprise value is the proper way to value the company, not based on market cap. So you get the cash and you can pay off the debt. So subtract cash, you assume the debt, so you add it. We're at 10.8 billion in enterprise value. There's 735 million shares here for a target share price I'm getting of $14.72. The current price is $9.10, which is a 60% margin of safety. But considering some of these more aggressive assumptions and that they can achieve the highest free cash flow rate of the peer group, and that everything pans out, a 60% margin on nearly perfect aggressively assumptions is I'd like to see something more in the 150 plus range. So try not to take up too much everyone's time here. I just realized I'm getting to 13 minutes here. So real quick, just add the shiner here. We got Open, Zillow, Redfin, OfferPad, Compass, and EXP. All comps here. So we got about five of them against Opendoor. Open's not in these medians. If you just look real quick, any pricing on profitability, none of them seem to be profitable. EV to EBITDA all negative. Price to earnings, all negative. Forward price to earnings, we're starting to get some positives here. It seems like these companies are more priced off of sales here. So, and we like to look at forward data rather than historical data. So we'll go here to the forward price to earnings, which is negative, but so then we'll hit the forward EV sales. So since they're not profitable, we'll use sales, and looking at the average of the group here, 7.49 Zillow being the outlier. The median would be 0.72. We can even take the more aggressive assumption of 224, and that would be for next year's sales, and we're projected at 4.1, the decrease, which would yield about 9.3 billion here in value, and then enterprise it out to about 10.6 billion divided by the shares, a price target of 14.49, 60% upside, very similar to the DCF scenario. So basically, to recap, we have the DCF here, and we got to about 1472 price target, and then we did the market approach and got 1449. So doing a weighted average, considering both, the income, the textbook way to do it, and the market approach, what it could go for in the market, which is the average of, some comps we see. I'm getting a price target here of 1460 and current price at 910. Margin side of 60, upside of 61%, I would say. to assume some of these, there has to be a lot of execution, and for, some of these more aggressive assumptions to be made, you would like to see a larger margin to safety. 60% may seem like a nice first glance, but some of these assumptions are, of the more fickle nature, and a change in the discount rate or a growth rate assumption, a change in the terminal value year could all lead to, you know, significant swings in the value 20, 30, 40%. All of a sudden a 60% margin of safety becomes 20. You usually like to see something well over 100% margin of safety. So you really feel confident that, if one of my inputs are wrong, at the worst case scenario, 50% swing is still 100%, undervalued. I'm not seeing a huge margin of safety here. Me personally, I would have used more conservative options, but I wanted to see with the hype around the new CEO and what free cash flow margins competitors are making. Well, in a perfect world, what they could do. But to me, I want to be a buyer at these levels.